So, everybody keeps banging on about index funds. Index funds this, index fund that. Oh please, give me a break. Well, we'll give you more than a break. We'll give you a breakdown of what index funds are and why they are so popular. As always, I like to start with the basics. In my previous video, I explained why saving money could actually make you lose money, and therefore some people might prefer investing it. One of the investment options is trading on the stock exchange. The idea is by buying a stock, for example, you would expect the value to increase over time. This is known as capital gains. Or perhaps you could expect the stock to pay you some dividends. Many investors use this approach, that is, trade in individual stocks following their own analysis. In 1976, John Clifton Bogle, also known as Jack Bogle, founder of Vanguard, launched the index fund. The concept was simple: a fund which effectively invests in stocks to replicate an index. The idea drew ridicule in Wall Street, but yet this was a revolutionary concept which over time defeated skeptics. Today, there are many index funds out there, each are tracking a different index. For example, the S&P 500, perhaps the most famous index fund, is tracking the S&P 500 index. Similarly, the FTSE Global All Cap Index Fund from Vanguard tracks medium and large companies around the world. So, why would someone want to invest in an index fund instead of buying individual shares? First, you need to understand the advantages of index funds. So I'll give you 4 advantages. Number 1, cost efficiency. To own a share and its returns, you would usually need to buy at least one share. To get the returns from the top 500 US companies, for example, you would need to buy at least one share of each of the 500 companies. In reality, this is market capitalization weighted, meaning you would need to buy in proportion of how much of the total market capitalization each of these companies represent. And once you've done that, you will need to do it all over again, because prices change and number of shares issued changes. For example, if you invest in an index fund tracking the S&P 500, you would only need to pay £46 per share. This share is fractionally invested in the share of those companies making up the index, such as Microsoft, Apple, Amazon, etc. If you were to buy them individually, each of them would cost you hundreds of dollars, even over $1,000 each. You would also have incurred transaction fees for each transaction, and this would make profits next to impossible to realize. If you're an individual investor trying to buy shares in multiple different companies, just like the index fund, it's simply not possible to do so cost effectively. Number 2 is reduce risk exposure. So when you're investing, there are a number of risks, quite a few of them actually, so let's go into it. So first of all, there's company risk, and I'm talking about underperformance, bankruptcy, perhaps it could be an isolated internal issue such as fraud, think Enron, or it could also be industry risk. For example, the industry could collapse due to specific issues in the industry. Think of the dot-com bubble crash, for example. Other risks to consider here is country risk, so we're talking about political stability, uncertainty around trade wars, for example, or Brexit. Also, you need to consider fund manager risks, so whereby the fund manager makes poor decision and loses investors' money. That's the story of Neil Woodford, the British Warren Buffett, until he lost over £7 billion of investors' money. The other risk you need to consider is creditor risk, particularly for bonds. So what if they don't repay the principal and interest? That's not good news. There's also interest rate risk, so changes in the interest rate will affect the bond value. And lastly, the liquidity risk. So if you can't sell your asset when you need it, think of a house, for example, as I covered in my previous video. And there you have it, the risk associated with investing. And that's where index funds really shine. They cut across these risks by allowing you to invest across multiple companies, multiple sectors, across countries, eliminating fund manager risk as it's passively managed, and it's tracking an index, and it will do that for a low cost. Which brings us to point number 3, it's low management fees. As mentioned previously, because it's tracking an index rather than paying a fund manager to make investment decisions, this results in lower costs, which means you get to keep more of the money you make. In a report a couple of years back, the statistics of how many fund managers beat the S&P 500 was shocking. At least 93% of fund managers failed to beat the S&P 500. Now if you think about it, generally mutual funds charge 1 to 2% of management fees, some even higher, which means that if your fund was earning 7%, you would only keep 5%. That 2% difference really adds up over the long run. So if you invested $1 at 5% and $1 at 7%, in 50 years, the 5% yield returns $10. The 7% yield returns $30. The fourth advantage here, and I'm ashamed to admit I love this one, is there's little work required. Index funds are easier to manage as you don't have to be on top of the latest news regarding each company that you would have otherwise invested in individually. For example, if you invested all your money into Apple stocks, you would need to be aware of the latest developments and anticipate any short or long-term prospects. Then you would probably need to decide when you want to buy or sell. And if you do that for a few companies, it can take a lot of time and effort. And many of us, particularly me, don't have this luxury. So I've spoken about the advantages, but what about the drawbacks? Are there any? There is. While index funds might be one of the safest options for investing in the stock market, it may not be the most lucrative option. There are a number of stocks that have had remarkable growth over the past decade. Think for example big names like Apple, Alphabet, Facebook, Amazon. Investing in those a while back would have made you a fortune. But you might also have lost money in other companies which went bust, such as Thomas Cook or Lehman Brothers. To make money that way, you would need to be on top of the game, nothing short of an expert, just like Warren Buffett. And as we saw earlier, even these experts get it wrong. The other drawback here, and that's something Jack Bogle himself expressed concerns about, is loss of voting power. As more shares are being held in index funds, particularly by institutional investors, companies are less likely to be held accountable. Simply put, shareholders have voting power to approve a board of directors who effectively steer a company. The issue is that when you invest in an index fund, you don't directly own a share in the underlying companies. You do so indirectly. Instead, the index fund manager gets the voting power, and this great concentration of power is making people uncomfortable. People also tell me that index funds take the fun out of investing. This is true, but my response to them usually is, I don't invest for fun, I invest for returns. So, to summarize, index funds allow you to reduce your risk exposure while still beating 90% of actively managed funds. It's low cost and low maintenance, which means you can usually kick back and relax a bit more. This is why so many people love it. I certainly do. However, it also comes with some drawbacks which I just explained. I hope you enjoyed this video. Click on the like button if you did and subscribe. Also, let me know in the comments below what are your thoughts on index funds. It'd be good to see the mixture of comments. And thank you for watching.